Hi, I'm Saurabh Mukherjee. I'm the CEO of Institutional Equities at Ambit Capital. I'm here today to take you through some of the critical concepts in business and finance and help you understand how to invest your money. We'll focus on how a business functions, how a company actually generates cash flow, how a company makes money, how does the running of a business, the day-to-day operations of a business actually translate into cash flows for the company and then returns for investors. We will focus on several critical metrics that are involved in running a business. Just to take you through that, we will use an example of a company you'll know well. Colgate-Palmolive, a company I'm sure many of you would have come across. They sell a broad array of products, and we will use Colgate to understand a whole range of concepts. We'll focus on sale value or revenues, cost of goods sold, gross profits, selling expenses, operating profit, return on capital employed, and then onwards to profitability and cash flows. And the broad structure we will follow is we'll try to trace a 100 rupee toothpaste down the profitability curve and onto cash flows and how that translates into return for investors. Now, I'm sure most of you would have come across Colgate-Palmolive. Its products are used ubiquitously in our country. Indeed, the products are used across the world, and in the toothpaste industry, Colgate is synonymous with the product that it is the market leader in. Understanding toothpaste and understanding Colgate-Palmolive is slightly different because Colgate also sells a whole range of other products. What we will do using Colgate-Palmolive's P&L as a structure is take you through what are the various layers of costs incurred in running a company. There's, broadly speaking, 3 layers of cost that we'll focus on. Firstly, the cost of producing a typical tube of toothpaste. These are the chemicals that go inside it, the operating costs of the plant. We will then look at administrative expenses of running a business such as Colgate-Palmolive. This is advertising costs, royalties, and we'll also focus on selling expenses, within which obviously advertising and marketing will feature significantly. We will drill through all of this using a hypothetical tube of toothpaste which costs 100 rupees. I know a typical toothpaste tube is not exactly 100 rupees, but I checked myself. It's a little bit more than that. But roughly, assuming that a typical tube of toothpaste is 100 rupees, how much does it actually cost to manufacture that tube of toothpaste? It's around actually 38 rupees. If you look at the ingredients of a toothpaste, you'll see items such as triclosans, sodium chloride. You'll also need to expend electricity on running the plant. And hence the cost of typical toothpaste tube is around 38 rupees, which leaves Colgate-Palmolive with 62 rupees of gross profit. That's what we call in our business 62% would be the gross profit margin. From 100 rupees of sales, they'll have 62 rupees of gross profit margin left. However, there are other costs that the company has to incur. And critical amongst them is an item called royalty. Colgate is an MNC company. The brand Colgate is actually owned by the MNC parent. And the MNC parent will charge the Indian subsidiary that's listed in India. They'll charge the Indian subsidiary a certain amount, and that amount is called royalty. So from every 100 rupees of revenues that Colgate earns, a certain amount will flow back to the parent as royalty, and that item forms the next layer of the Colgate's P&L. Other than royalty, the critical item to focus on is advertising expenses. Colgate spends a fair bit of money on advertising. Out of total sales of 4,000, nearly 10% goes into advertising. And you can see why. This is a FMCG company. It's a consumer goods company. It needs to get its message loud and clear that this is the market leader. And hence the outreach to customers via various forms of media is a critical part of this company's cost outlay. But if you put the whole thing together, if you put royalty, advertising expenses together, what is the overall picture that emerges? Let's look at that, because that gives you a fascinating breakdown of a very powerful company's cost structure. 100 rupees was the revenues we began with. Gross profits are 62 rupees. And from that, you knock off other expenses, critical amongst which are royalty. 26 rupees goes in that. And then you knock off advertising and promotional expenses of 17. And you're left with an EBIT, or also called operating profit, of 19 rupees. This is actually a very good number. From 100 rupees of revenue to actually get to 19 rupees of EBIT is no small feat. It's actually critical to why Colgate is such a powerful force to be reckoned with. It gives you it gives you a sense of how powerful this company is in terms of generating high levels of profitability from a product which is essential to our lives. If you look at sales of 100, which is what we began at, a hypothetical tube of toothpaste, which costs 100 rupees to manufacture, cost of goods sold of 38, leaving us with gross profits of 62, knocking off advertising expenses, other expenses, getting to the EBIT of 19. We now have to reckon with the next layer of cost, and that's taxes. You and I pay taxes. Corporates also have to pay taxes. The corporate taxation rate in India is somewhere around 30%, but companies such as Colgate are able to avail of certain tax breaks, which means that their tax rate actually comes in slightly below 30%. If you look at Colgate's FY15 annual report, what you'll find is that from operating profits of 780 crores, they paid taxes of 221 crores. That's a tax rate of around 28.4%. The reason it's below the typical corporate tax rate is Colgate is able to set up plants in certain locations such as Himachal Pradesh, where they get certain tax breaks, and that brings the tax rate down. And once again, let's use this to go back to our typical toothpaste of 100 rupees to see how much is actually left for the investor after the government of India has taken its stakes. So beginning again with sales of 100, our hypothetical toothpaste tube of 100 rupees, operating profit of 19 rupees. Remember, we are knocking off here the ingredients of a toothpaste, the advertising costs, the royalty costs. That left us with 19 rupees, the EBIT number that we dealt with. Knock off from that taxes of 5 rupees, and you're left with 14 rupees. It might not appear like a big number, but trust me, 14 rupees in a competitive sector like FMCG, out of every 100 rupees of revenue, is a very respectable show. This is also called the net profit margin, and 14% net profit margins are very creditable in a competitive industry such as FMCG. It gives you a measure of how powerful this company is when it comes to actually generating high levels of profitability. Now let's move on to cash flow. Profits is not cash. It's a common misperception that a business's profit is what it actually takes home. That, however, is not the case. Profits are not cash. Cash flow is a more dynamic concept, and let me try to illustrate the difference between profits and cash. Profitability is a straightforward concept, but unfortunately, it's also a little narrow as a concept. It looks at revenues and expenses, income and expenses, in a certain time period. FY15, financial year 15, is the period we are focusing on. Cash flow, on the other hand, is a more dynamic concept. What cash flow is looking at is the movement of money in and out of a business. So if I'm a toothpaste manufacturer, the cash flows that I'm receiving are the revenues that my customers are paying me. My costs are the payments I'm making to my suppliers. The quicker my customers pay me, the more cash I have. The more slowly I pay my suppliers, the more cash I have. Typically, therefore, high-quality companies get their revenues quickly from their customers and pay their suppliers over a course of time. Colgate pulls this off very well, and as a result, as we will see, the cash flow metrics are actually very powerful. Operating cash flow is the metric to focus on. So if you look at a company's cash flow statement, look for the operating cash flow figure. For Colgate, this number was a punchy 844 crores in FY15. As a result, what we call the operating cash flow to operating profit ratio, CFO to EBIT, as is shown here, was 108%. Now, just to give you a sense of how powerful this is, a typical corporate in India will have a CFO to EBIT ratio of around 60%. So therefore, to have a CFO to EBIT ratio of 110% gives you a sense of how able Colgate is to translate its EBIT, which was the 19 rupees out of every 100 we discussed, into a cash flows of 21. 110%, 108% cash conversion ratios. CFO to EBIT is also called the cash conversion ratio. These are very good ratios, and 21 rupees of operating cash flow for every 100 rupees of revenues is actually a measure of how able this company is to generate cash. Now, why is cash important? Cash is important because it allows able companies, powerful companies, to actually pay greater sums out to shareholders. Unless you're able to generate these sorts of levels of cash flow, you're neither able to reinvest in your business, nor are you able to actually return money to shareholders and help shareholders make more money. Let's look at dividends, which is the cash that the company actually gives back to the owners of the company, to the shareholders of the company. Remember, in Colgate's case, the biggest shareholder is its MNC parent, and hence a big chunk of the dividends that Colgate India pays out goes back to the MNC parent in the United States. So all of what we have focused on so far has been about how does a company actually generate cash. We've looked at Colgate Palmolive's hypothetical toothpaste tube of 100 rupees. We've said that that generates 19 rupees of EBIT, 21 rupees of operating cash flow. Those are very powerful metrics, I have stressed. Why does this matter? This matters because if a company generates high levels of cash flow and high levels of profitability, it can actually pay out a lot of money as dividends. If you look at Colgate's FY15 annual report, the metrics that we see in this regard are actually quite stellar. 559 rupees of net profit, this company is paying out something like 326 crores as dividend. That translates into a dividend payout ratio of 58.4. And ratios such as this, 60% payout ratios for a large company as big as this, is actually a very powerful source of return for shareholders. The reason cash flow matters, the reason high levels of operating profit matter, is that for well-run companies, it allows them to generate very high levels of dividend payout ratio. That's actually cash that goes back to shareholders. That's hard cash in their pockets.